Backtested, Episode 1. I tested Alexander Elder's triple screen strategy on SPY for 10 years. Here's what happened. What if I told you that one of the most celebrated trading systems in history, a method so respected it's been taught in trading books for over 3 decades, returned just 5.3% per year when tested on real data? And that's simply doing nothing, just buying and holding the S&P 500, would have made you nearly 5 times more money over the same period? That's exactly what I found when I ran the numbers. And today, I'm going to show you every step of how I tested it. Welcome to Backtested, the channel where we take classic trading strategies, run them through real historical data using Python code, and report exactly what we find. No hype, no cherry-picked results, just the numbers. Today we're testing the triple screen trading system, developed by Dr. Alexander Elder and first published in his landmark book, Trading for a Living. If you've spent any time in the trading world, you've probably heard of this book. It's sold millions of copies, been translated into dozens of languages, and Elder's triple screen method has been called one of the most complete trading systems ever designed for individual traders. So the question is simple. Does it actually work? Let's find out. The triple screen system gets its name from the fact that it filters every trade through 3 separate screens before you're allowed to enter a position. The first screen looks at the weekly chart. Elder believed that most traders make the mistake of only looking at one time frame. His solution was to start one level higher than you normally trade. So if you trade daily charts, you look at the weekly chart first. On the weekly chart, you use the MACD histogram. That's the difference between the MACD line and its signal line, and you watch its slope. If the histogram is rising, the weekly trend is up. If it's falling, the trend is down. This is your tide. You only take trades in the direction of the tide. The second screen drops down to the daily chart. Here, Elder uses an oscillator. In our backtest, we use the 2-day exponential moving average of the force index, which combines price movement and volume into a single number. When the weekly trend is up, you wait for the daily oscillator to dip into negative territory and then turn back up. That pullback is your wave, your entry opportunity. The third screen is the entry trigger. Once screens 1 and 2 are aligned, you place a buy stop 1 tick above the previous day's high. If price breaks out above that level, you're in. This is your ripple, the precise moment you enter the trade. Your stop loss is set 2 ATRs below your entry price, and you use a trailing stop to protect profits as the trade moves in your favor. It's an elegant system. It has logic, structure, and a clear rationale behind every rule. So what happened when we actually tested it? I coded the entire system in Python using 10 years of real daily price data for SPY. That's the S&P 500 ETF from July 2016 to June 2026. The rules were implemented exactly as Elder describes them. Weekly MACD histogram slope for the trend filter, 2-day force index EMA for the daily oscillator, previous day high breakout for the entry trigger, and a 2 ATR trailing stop for exits. I started with a hypothetical $100,000 account. No leverage, no short selling, just the long side of the system, which is the setup Elder emphasizes most. Over the 10-year period, the system generated 69 completed trades. That's roughly 6 or 7 trades per year, which is actually quite low. This is not a system that has you in the market constantly. Here's where it gets interesting. Of those 69 trades, 47.8% were winners. So slightly less than half the trades made money. The average winning trade returned positive 3.26%, while the average losing trade cost negative 1.46%. That gives you a reward-to-risk ratio of about 2.2 to 1, which on paper sounds reasonable. But the overall numbers tell a different story. Over 10 years, the triple screen strategy turned $100,000 into approximately $166,800, a total return of 66.8%, or 5.3% per year compounded. The maximum drawdown, meaning the largest peak-to-trough decline in the portfolio, was 17.3%. Now compare that to simply buying SPY on day 1 and holding it. Buy and hold turned the same $100,000 into roughly $414,400, a total return of 314.4%, or 15.3% per year. The triple screen system underperformed buy and hold by more than 10 percentage points per year, every single year, for a decade. So why did a well-reasoned, structured system fall so far short? There are a few data-driven explanations. First, the system keeps you out of the market most of the time. With only 69 trades over 10 years, the strategy spends a large portion of time in cash. During one of the strongest bull markets in history, sitting in cash is expensive. Every day you're not invested in SPY during an uptrend is a day of returns you're missing. Second, the trailing stop gets triggered frequently during normal market volatility. SPY regularly experiences short-term pullbacks of 5 to 10% even within strong uptrends. The 2 ATR stop, while logical for risk management, exits many trades before they have a chance to develop into the large winners that would move the needle. Third, the force index oscillator generates a lot of signals in choppy, sideways markets that don't lead anywhere. The first screen filters some of these out, but not all of them. The result is a meaningful number of small losing trades that slowly erode the account during range-bound periods. Fourth, there's the issue of slippage and execution. In a real trading account, you don't always get filled at exactly the price the backtest assumes. By stop orders placed above the previous day's high can get triggered during volatile opens, sometimes at significantly worse prices than the model expects. When you multiply that effect across 69 trades over 10 years, the real-world performance would likely be even lower than what our clean backtest shows. This is something most trading books don't talk about openly, and it's one of the reasons why strategy performance in live trading almost always falls short of backtested results. What does this tell us? It tells us that a system can be logically sound, professionally designed, and still underperform a passive index in a prolonged bull market. That's not a failure of the system's logic. It's a reflection of the specific market environment we tested it in. A system built around catching trends may perform very differently in a flat or declining market. That's a backtest for another episode. What Elder's system does offer, and this is worth noting, is a maximum drawdown of 17.3% compared to buy and holds deeper drawdowns during the 2020 crash and the 2022 bear market. For some traders, sleeping better at night has real value. The data just shows it comes at a significant cost in returns. There's also a broader lesson here about the difference between a system being logically sound and a system being profitable in a specific market environment. The triple screen was designed in the 1980s, in a market with very different volatility characteristics than what we see today. Algorithmic trading, ETFs, and the sheer speed of modern markets mean that patterns which worked reliably 30 years ago may be far less consistent now. That doesn't mean Elder's work has no value. The core principles around multiple time frames and disciplined entry triggers are still widely used by professional traders. It just means that no system should be used blindly without testing it on the actual market conditions you'll be trading in, which is exactly why this channel exists. That's the triple screen trading system, tested, measured, and reported honestly. The code for this backtest is available if you want to run it yourself and change the parameters. I'd be curious what you find. This video is for educational purposes only and is not financial advice. Every strategy performs differently depending on the market environment, the asset tested, and the specific rules you use. If you found this useful, subscribe. We test one classic strategy per week using real data. And drop a comment below.